If you're wondering how people and other investors earn millions and billions becoming super rich overnight, if you thought that the same comes only from the practice and knowledge about the market and maybe a little guessing game, well, you would need a bit of correction here. People win and become millionaires and billionaires not just by experience, rather they grow through a lot under the market and most importantly, the charts. Hello everyone, welcome back to the channel, Business Bro. If you're new here, please allow us to enlighten you that we're giving away 1,000 Dogecoin to our random subscribers. All you need to do is like the video, subscribe, and comment your favorite crypto coin in the comment section. Good luck! Trading is something in the current world that has gained a lot of attention. Warren Buffett says you need to find a way to earn while you sleep, or you'll have to work for your entire life to make a living. Some people might not agree with investing. Well, this is certainly understandable because a lot of risk factors are involved. However, if you know what you're doing and of course are aware of the market and the technical part of trading, then you have a fair chance of winning at least some dollars. There is one thing that you need to understand strictly. Investing and trading, no matter how amusing it may sound, the same does not come positive to everything. Every billionaire who you're looking up to now must have had a few downfalls while he was trading. He must have experienced the same falls and dumps, and that is totally fine. You need to accept it. Trading comes with these risk factors. If only you're aware of it and agree to take such risk, then watch this video to the end to understand every aspect of trading, the technical version. Before starting, there are certain things that you need to know. Firstly, technical analysis is not accurate every time. There will be faults and the market can deviate from what you've predicted. The most you can do is to speculate, and if your calculations are right, boom, you're likely to hit the jackpot. So, first of all, you need to be thorough with what technical analysis is. This term is often referred to as charting, where you are required to predict the future of the market behavior based on the previous price action and volume data. Volume data or cryptocurrency trading, which is another fundamental concept that involves the buying and selling of cryptocurrency assets. Meaning, whenever people buy or sell cryptocurrency assets, that amounts to trading, and when such trading happens in a massive amount, the same is recorded and presented in a graphical format or charts, which is needed to be studied and analyzed to understand the pattern and predict the future of the cryptocurrency price trajectory. Technical analysis involves the analysis of the historical price action, which may indicate the future pathway of the market. Herein, we look into the historical activity and try to identify the opportunities based on that. Technical analysis is not just a tool to predict future price movement probabilities. It can also provide a useful risk management framework. As a model for analyzing the market structure, the technical analysis makes management of the trades more defined and measurable. Risk measurement is the first step in this direction. In this context, this is why certain technical analysis cannot be strictly considered traders. Technical analysis can be used purely as a risk management framework. The technical analysis practice can be applied to any financial market and is widely used by traders of the cryptocurrency. But is technical analysis functioning? Well, as we said earlier, speculation is mainly responsible for evaluating the cryptocurrency markets. This means that technical analysis can play an ideal role because they can only prosper in light of technological factors. Now let's understand what fundamental analysis is. With cryptocurrencies, fundamental analysis can also include an emerging field of data science that is concerned with blockchain public data known as on-chain metrics. The network hash rate, the top holders, the number of addresses, transactions analysis, and many more can all be included. Analysis can create complex technical indicators using a large number of available data from public blockchains to measure specific aspects of the network's general health. This is something used majorly in the stock market. However, since this class is new, there isn't a comprehensive framework for determining market valuations. When we talk about cryptocurrencies, the first step to understand this asset would be the concept of blockchain. In simple terms, the concept of blockchain means the storehouse of transaction records in an encrypted manner. Blockchain is a digital ledger that stores transactions that are distributed all across the computer system. Cryptocurrencies have blockchain or digital ledger which vary. Therefore, a blockchain recording system is one technology that is impossible to be broken, amended, hacked, or cheated. This digital ledger of transactions can be duplicated and distributed all across the entire network of computer systems on the blockchain. Now that we know how a cryptocurrency functions, the next part would be to understand what a market is in the literal sense. When we talk about a market trend, we mean the overall direction of the asset's price, where it's heading. While doing technical analysis, we understand the market trend using the price action, trend lines, or even crucial indicators, which we'll deal with later. So, when we identify a market trend, you drive that the market is bull or bear, meaning a bull market is one where the price action or the market consists of a decent uptrend on the price trajectory or where the prices are going up. In the case of a bear market, the price trajectory experiences a sustained downtrend, meaning the prices are continually going down. Apart from these, we also identify market patterns as sideways when there isn't a clear directional trend. You must have heard the phrase that the market moves in cycles. A cycle is a pattern or trend that arises at various times, and markets are cyclical in nature. Typically, higher term market cycles are more reliable than lower time market cycles. However, small market cycles can be found on an hourly chart, just as you can when looking at decades of data. The market will always be in a circle, however, it is almost impossible to determine at any given moment where we currently are in that cycle. We now understand a few market terminologies and trends. Let us now look into specific trading strategies, which are the most common ones, and people use them every time they trade. When you start or plan to start trading, you cannot simply invest money in a random token. There is a must requirement of a strategy or plan as how you will invest your money and the time frame. This also includes what you're expecting at the end of your investing period. A trading strategy is something that is a must to follow. Well, this is simply a plan for you to follow when executing your trades. And since it depends on your thought process, objective, and investment nature, and is it subjective, there is no single correct approach to trading. Irrespective of your approach to trading, it is crucial to establish a plan outlining clear objectives and preventing you from progressing due to emotion. Usually, you want to decide what you trade, how you trade it, and where you're going to enter and leave. Buy and hold. This is the first strategy that we believe is the most widely used and is the wisest at the same time. As the name suggests, you actually buy your position and you hold it. It might come as a bit unsurprising, but it is the most commonly used method. It straightaway involves the buying and holding of an asset. This is certainly not for short-term holders. This is a strategy primarily practiced by long-term players interested in passively playing and leaving the asset alone irrespective of the market conditions. Herein, if you have invested today and you look forward to holding it for a considerable time, even if the market falls tomorrow, you will not eliminate your position. Holding, which usually refers to investors who like to buy and hold for years instead of trading actively, is an excellent example of this in the crypto area. This could be a practical approach for those who prefer investment because they don't have to worry about fluctuations in the short term or capital gains taxes. On the other hand, patience is required on the part of the investor, and the asset is not entirely worthless. Swing trading. In this concept, you do hold the token, but the time frame is pretty much fixed. Unlike buy and hold, you actually take off the profits in the market trend, but the time frame is much longer. These are typically held anywhere from a couple of days to a couple of months. Majorly, the asset you're looking for here is something that is currently undervalued, but you believe that it is likely to increase in value. Apart from this, there is one other way to swing trading. You can fund assets that are currently overvalued and are likely to decrease in value. Therefore, you will buy the asset when they are rising in value and sell them at a high price, and buy them again when they fall at a lower price. Since this is a pattern, the same higher price cycle will be repeated. Swing trading is a much more beginner-friendly strategy, because firstly, it does not come with the stress of fast-paced day trading where you enter and exit positions within the same day and rely mostly on technical analysis. Day trading will also involve a lot of screen time and rapid decision making, whereas swing trading allows you to take your time. Day trading is done by professionals who have a pretty good hold on the market. It is indeed a very active trading strategy and can be highly profitable. However, it carries a considerable amount of risk with it. Asset allocation and diversification. This is a straightforward principle that applies in everyday life as well. Asset allocation and diversification are terms that are used interchangeably. Let's explain it in simpler terms. It's the same as the principle saying don't keep all your eggs in one basket. Keeping all of your eggs in one basket would prevent a central point of failure, and the same holds true for your wealth. So when you invest a massive amount of money in one asset, you would be exposing your life-type investment to a massive kind of risk. Furthermore, if you are logically allocating your investments into several other assets, the same will enhance your portfolio to a great extent. Ideally, your wealth should be spread over several classes. In this way, you don't knock on the rest of your portfolio if you don't perform well. This idea has been introduced in modern portfolio theory by Nobel Prize winner Harry Markowitz. In essence, the theory argues in the combination of uncorrelated assets that reduce volatility and risk associated with portfolio investment. Let us now talk about two important investment strategies. These are the ones that you strategize according to your return goals. Long position. This is the first type of investment strategy that you formulate when you're looking forward to a long-term return in a considerable amount. Long positioning means that the buyer will be based on the expectation that the value will rise in the long run. In derivative products or Forex, however, they are essentially applicable to any asset class or market type. In the hope that its price will rise, purchasing an asset on the spot market is also a long way away. The most common way of investing is to go a long way on a financial product, particularly for those just beginning. Long-term trading strategies such as purchasing and holding are supposed to increase the underlying asset's value. In this sense, purchase and maintenance simply take a long time. Shorting. It is the complete opposite of a long position. This implies a short position wherein the products are bought with the intention of rebuying them again at a much lower price. This concept is closely related to margin trading, which is a method of trading using borrowed funds from a third party, which is also used extensively in the derivatives market and can be carried out with a simple location. Then how does the shorting process work? It's quite simple when it comes to shortening the spot markets. Let's say you have Bitcoin already and expect that the price will fall. You sell your BTC at a lower price later on so you can rebuy it for USD. In this case, because you sell high to buy less, you essentially enter a short position on Bitcoin. So you borrow an asset that you think may decrease in value and you immediately sell it. So when the price of the asset actually decreases and falls, you buy them back the exact same amount that you borrowed. Now you repay the asset that you've borrowed along with the interest and profit from the difference between the price you initially sold and the price you rebought it for. Now that we know what the market is and what type of investment people usually make, let's look into the different indicators that are the most essential in determining the market prediction. So, the first and foremost thing is to find out the trading signals. In technical analysis, indicators are useful for identifying general trends and providing insights into the potential entry and exit points. These are trading signals. You are finding the signals generated on the occurrence of specific events in an indicator chart. The first in this list is the trend line. What is a trend line? Trend lines are a common tool used by traders in analysis. These lines connect some data points on a diagram. Typically, but not in all cases, this data is the price. In technical indicators and oscillators, certain traders might also draw trend lines. On the basis of the higher and lower parameters of a chart, trend lines show where the current trend was briefly challenged, tested, and reversed. The line can be extended so that important levels will be predicted in the future. The trend line can be tested several times, but it is considered valid as long as it is not broken. The main idea behind drawing trend lines is that certain aspects of price action are visualized. This allows traders to determine the overall trend and market structure. On a price chart, when you see a perfectly straight line formed by the price pattern, it is a trend line. If the line is going up, then it is a positive trend and it is likely to continue that way. If it's going down, it's a negative trend line, meaning the price is likely to fall. Support and resistance levels. Support is a level with a floor in the price. In other words, an area of significant demand is a support level, in which purchasers step in and push up prices. Resistance signifies a level of ceiling for the price. A strength is an important area of supply in which sellers enter and decrease their prices. By these levels, you can easily identify which point the price is likely to hit. If you see a heavy buy-in force, you will look forward to the next resistance level as a target, and if the price is falling, the immediate support levels to be your target support. Trading volume. This is the number of units traded for an asset at a certain time. It basically shows that during the measured time, the amount of this asset has changed. This is a very important technical indicator, therefore that helps to assess how well the coin is used on the market. The underlying strength of the coin can also be determined, so when you know there is a high trading volume on a coin, the buying force will also be high. Relative Strength Index. This indicator helps to determine whether the asset is overbought or oversold. The same is determined by a momentum oscillator that will indicate the rate at which the price changes happen. The data is shown on a line chart, and the oscillator varies between 0 and 100. When the momentum is rising and the prices are going up simultaneously, the uptrend is considered strong and extended. Proportionally, if the momentum is decreasing in an uptrend, the uptrend is likely to be considered weak. Moving average. Moving averages are calculated based on previous data in order to smooth out price action, and it is easier to spot market trends. There are two types of moving averages. One is the simple moving average, and the other one is the exponential moving average. Lagging indicators. They confirm events and trends that have already happened. These indicators are typically applied to longer-term chart analysis. Leading indicators. These indicators are essentially used for short and mid-term analysis. They are being used when analysts anticipate a trend and search for statistical instruments to support their assumptions. Leading indicators can also be used for the predictive qualities with regard to trade and technical analysis. Bollinger Bands. This indicator was named after John Bollinger, effectively used to measure market volatility, and is often used to spot overbought and oversold conditions. This indicator consists of 3 lines, an SMA, a middle strip, and a top and bottom strip. These bands in the price action are then placed on a chart. The idea is that the gap between these bands will change, expand, contract as volatility increases or decreases. Fibonacci retracement. A popular indicator based on a string of numbers named Fibonacci sequence is called Fibonacci removal or Fib retracement. The Fibonacci numbers are derived as percentages. Those percentages are then diagrammed and can be used by traders to identify possible support and resistance levels. The main idea for a graph to identify areas of interest is to draw percentages on a graph. Traders usually choose 2 significant price points from a diagram and pin to the points the 0 and 100 values of the Fib retracement tool. The scope between these points can highlight potential entry and exit points and help identify the positioning of stoppers. Now let's look into certain patterns that you need to look into for predicting the immediate price trend. Charts patterns from consistently over a period of time. Therefore, a well observation of these might fetch you a great return opportunity. Head and shoulders patterns. Herein, the pattern forms multiple peaks with a proportional rise and decline. The head and shoulders chart shows that the uptrend is approaching its end, a bullish to bearish reversal trend. Investors believe that this is one of the trend reversal patterns most reliable. Ascending and descending triangle. Ascending triangle is a bullish chart that indicates a positive price breakout where the triangle lines are likely to converge. A descending triangle represents a bearish market where there is a possibility of a downward breakout. Wedge. This pattern signifies a tightening price movement between the support and resistance lines. This can either be rising or falling. Cup and handle pattern. Sticking rightly to the name, this pattern resembles a cup and handle where the cup is in the shape of a U and the handle has a slight downward drift. This is usually a bullish signal signifying a greater buying force on the asset. These were the few most prominent price patterns you should always look into while doing technical analysis. Although indicators contain data, it is crucial to consider the very subjective interpretation of those data. Therefore, it is always helpful to consider whether your decision-making influences personal prejudices. It may be only market noise for another trader, which can be a direct buy or selling signal. That's all for today's video. Thank you for watching. If you found this video informational and wish to win the giveaway, make sure to hit the like button, subscribe to the channel, and press the bell notifications. Don't forget to comment below your favorite technical indicator, and we'll see y'all in the next one.